Hello ladies and gentlemen, and welcome to the Swaraj Finance channel. This is the first of our YouTube videos, and so thank you all for taking the time to watch. In this video we're going to go through an article which we've recently released on our website, the link for which you can find in the description below. And in this article we go through the case for precious metals as a medium of savings and as an investment over the next 5 to 10 years. Before proceeding, I have to mention our disclaimer that anything you see in this video is not to be taken as personalized financial advice. It merely represents our financial opinions and a collection of information and data from the financial markets. You must do your own due diligence and consult a financial advisor for personalized financial advice. So, without further ado, I'm going to go through some of the important aspects of this article. We discuss the excess liquidity and how there's been a bit of a bubble in US equities in particular, and how gold, in our opinion, represents somewhat of an anti-bubble. So the first important chart is this gold to S&P 500 ratio. It tells us the price of gold in relation to US equities. And as you can see, we're currently sitting at very low levels for gold, where in the past, whenever it's come to these levels, we've seen a huge outperformance of gold relative to US equities at some point following these levels. So we could stay here for a period, we don't know how long, but it certainly presents itself as an opportune buying moment for gold if you're seeking outperformance relative to US equities. The next chart is a chart of central bank gold purchases, and this is a chart from the World Gold Council. And as you can see, the purchases of gold in 2022 were the highest on record, and the records go back to 1950, which is over 72 years. And so you can see in this last year, central banks around the world have purchased more gold than they ever have in a single year since the records began. And if that's anything to go by, I would suggest that they're purchasing with good reason, and central banks, whilst you might not want to listen to what they say, you should look at what they do. We've then presented the case for silver, and as you can see in this chart of the silver to gold ratio, silver is appearing very cheap on a historical basis relative to gold. So since around 1970, we've been in a downward trend where silver has become increasingly cheap relative to gold, and it has its spikes, its moments when there's a precious metals bull market, such as in 2011. We see silver outperforming, and so it has its peaks, but every time the peak is lower. So you have this downward wedge pattern, which we're approaching the corner. And even if silver were to just rise and touch the trend line again in the next precious metals bull market, which we anticipate happening in the next few years, that would mean silver outperforms by a factor of 2 to 1. So it would double relative to the price of gold, just to touch this trend line. If it were to break out of this long downward trend, then we could see a huge outperformance of silver. But silver remains relatively cheap in relation to gold. So I just want to go through a few more charts, which we've not included in the article, as a bonus. So in this chart you can see the gold and silver miners relative to the US equities or the S&P 500. And again, the gold and silver mining companies are very cheap on a historical basis relative or as a percentage of the broader US equity markets. And they're currently sitting at levels which were last seen in the year 2000, which was just an inflection point for the precious metals market. And if you'd bought at that point, you would have seen an outperformance of the gold and silver mining companies relative to the US equity market of around 400%, or a five times outperformance over the next 10 years. If there is indeed a precious metals bull market pending, then we'd expect the gold and silver mining companies to outperform the broader equity markets. So not only are the gold and silver miners cheap relative to the US equity markets, but they're also cheap relative to the price of gold itself. And as you can see in this chart, between 1984 and 2008, the gold and silver miners, represented by the ETF XAU, were between 0.2 and 0.35, say within this range of the price of gold. We're currently sitting at 0.05 more or less, meaning that if the miners were priced relative to gold as they had been historically, we'd expect at least a 5 times outperformance of the miners relative to the performance of gold, if they were to revert to the range which we'd seen prior to the 2008 global financial crisis. So there's some charts, and if you want to take a look at the article, please do visit our website. The link is below in the description. I hope you can see the case we've presented for precious metals looks quite strong in our opinion. And for those that want to have an insight into which particular gold and silver mining equities could be bought as a part of one's portfolio, then you can do so by subscribing to our Patreon community. Again, we've provided the link below in the description. And as part of this service, we offer monthly insights into our model portfolio, in which precious metals, gold and silver miners comprise a significant allocation. And you can see the specific companies that we've selected in our model portfolio. We provide monthly updates on when we're buying and selling particular stocks. And we provide quarterly research reports and other important updates in relation to the financial markets. So you can subscribe to our Patreon service, and because we're in the launch phase, you can currently subscribe to this service for a 25% discount, early bird offer. So do check that out if that interests you. Otherwise, we hope you've enjoyed watching. Thank you all for watching. Please share this video, like and subscribe to the channel. Share with anyone who you think might benefit from the information provided, and we look forward to bringing you another video soon. Take care. Bye.